Everyone, welcome to our DAT IQ Weekly Market Update. This is our update for July 23. This is episode 301. I'm Dean Croak, market analyst here at DAT. Special guest today, along with my co-host Chad Kennedy, is Lee Klaskow, Senior Analyst of Transport and Logistics of Bloomberg Intelligence, and also host of the podcast Talking Points. Welcome to the show, guys.
Thanks, Dean.
Good to have you with us.
Thanks for having me.
Yeah, always good to have you back, Lee. It's been a few, weeks or months since we were in New Orleans together?
I think a few weeks.
Yeah.
I think so, right?
Gosh, I lose track.
4 weeks?
Yeah.
All the days tend to blur together. I know.
They do. Lee, tell us a little bit about, for those that don't know who you are, which I'm sure there's not many, but tell us a little bit about yourself, what you do at Bloomberg, and then we'll dive into the rest of the show.
Sure. So I work for Bloomberg Intelligence. It's Bloomberg's internal research arm. We have over 500 analysts and strategists globally. We cover all investment vehicles, whether credit, equity, all across the board. We also do it from a regional standpoint with people located in North America, Europe, and Asia. I've been doing it here, covering the freight, transportation, and logistics markets at Bloomberg Intelligence for about 14 years. I had 6 years of additional experience prior to coming to Bloomberg on the sell side, covering the same space. I pretty much cover all modes. So while trucking is near and dear to me, I also cover railroads, marine shipping, air freight, and 3PLs as well. So pretty broad in my coverage, and I cover also around 22 individual companies. And in addition to that day job, I do host Bloomberg's Talking Transports podcast, which could be found where all great podcasts are found. Yeah.
Well, looking forward to chatting to you about some of those topics, including intermodal. That's a big competitor of truckload, so we might dive into that a little bit later. We'll bring Lee back towards the end of the show. We'll get started with the market update section. Some of the key points we're watching this week, dry van and flatbed rates almost identical to this time last year. They did lose a little bit of ground last week, but reefer line haul rates did hold firm at about $2 a mile. That was slightly surprising. Jason Miller's truckload ton mile index for May came out, much awaited result. Jason thinks we continue along the bottom of a trough, albeit at levels comparable to what he observed in late 2018 in terms of absolute demand. Jason pegs truckload demand based on 41 freight generating commodities at about where we were in Q4 of 2018. Cash shipments came out. Tim Benoyer's excellent report on the freight index. Volumes were down 1.8% in June, highlighting the ongoing softness in the for-hire demand sector. That report can be found at the Cash Shipments website. June imports surprised a few of us, surged in June, second highest level since 2018 for a monthly TEU volume. It was only surpassed by May of 2022. June was even higher than June of 2021 during the pandemic. Volumes in Los Angeles up about 23% month over month. New York down 2.4%. Imports from Northern Asia are up 11% month over month and just shy of the highest June TEU volume we've ever recorded. They're only about 7,000 containers shy of that record, that all-time record, driven by toys, menswear, footwear, of course, ahead of back to school and more recently Amazon Prime Day. The long-form version of today's market update we published this evening, dat.com/market update. This week we're talking about Brake Safety Week in August and how the unannounced Brake Safety Day in July caught a lot of carriers off guard. We're also talking about the Logistics Managers Index, layoffs at large machinery OEMs, some nearshoring going on to Mexico is affecting flatbed demand, particularly in the Midwest. And we're talking a little bit about blueberries and the blueberry capital of the country, or in the world, in fact, according to the folks in Hamilton, New Jersey. That report will be out this evening. Check it out. It'll have all the charts and graphs in from today's report. So let's have a look at the load to truck ratio. Dry van load post volumes retreated last week following the prior week's surge. Last week's volumes were about 13% higher than week 29 levels over the last 7 years. So we're seeing a lot more load post volumes. Carrier equipment posts mostly flat last week, although they are down compared to last year as capacity continues to exit the market at a slower rate. Load to truck ratio at 4.00. That's the third highest load to truck ratio we've seen for week 29 back to 2016. In the reefer market, load post volumes dropped last week, as they typically do, following a slower week reported by the USDA. Produce truckload volumes impact the reefer market significantly, 5% lower than last year, according to the USDA. California's volumes are down by a similar amount. This is significant for reefer carriers because California produces around 40% of national weekly volume at this time of the year. Carrier equipment posts were down slightly, load to truck ratio down at 6.33, down about 10% week over week. And in flatbed, even though load post volumes dropped 8% last week, they're still 17% higher than last year. Carrier equipment posts down slightly, load to truck ratio down to 12.47. So having a quick look at some of our rates, the year-over-year look at spot rates following the July 4 seasonal peak, line haul rates have dropped by almost 5 cents a mile in the last 2 weeks. At $1.65, the national average is 1% lower than last year and about a penny per mile higher than the 3-month trailing average. On our top 50 lanes, based on the volume of loads moved, that cohort dropped 2 cents a mile to 206. That's about 41 cents a mile higher than the national average. And in the refrigerated market, usually following the July 4 peak, which is fairly consistent year over year, the national average reefer line haul rate usually trails off after we get some produce volumes sort of falling away. They have fell away fairly significantly. The surprise last week, though, was reefer line haul rates were flat for the second week at $2 a mile. We'll cover a little bit of this later in the forecast. A penny per mile higher than last year and about 3 cents a mile higher than the 3-month trailing average. So certainly supports the theory that we're sort of coming off the bottom of this rather elongated trough that we've been in. And in flatbed, directionally flatbed rates are following solid seasonal trends. They're down 2 cents a mile to a national average of 202. Line haul rates are about 4 cents a mile lower than last year and about 6 cents a mile higher compared to 2019, which is the green line on the chart. Having a look at our forecasts, for those new to the show, the blue line is our rolling 7-day weighted moving average of historical rates for loads moved. These exclude fuel, so they're line haul only. The green line on the forecast is our ratecast model. It's in all of our products. Red is the short-term model. The green model ratecast weights more heavily the seasonal trends that we see each year. The red is heavily weighting more recently seen data, and the grey and the yellow are blends of the two. We will be changing these in the coming weeks. We'll be producing a ratecast forecast out 35 days with average and highs and lows, so look for that change shortly. Starting off with the dry van forecast, somewhat surprisingly, although not if you think about how much capacity has been exiting the spot market, we're seeing higher load post volumes. Load post volumes 13% higher than week 29 levels over the last 7 years. That's significant. While equipment posts are lower by about 18% year over year, that suggests a tightness of capacity emerging in the spot market. Hence, ratecast is seeing rates up about 3 cents a mile out to the latter part of August. The short-term model is a little bit more pessimistic. It's seeing rates decline a little bit further. In the refrigerated market, again, somewhat surprisingly, equipment posts are about 25% lower year over year. So there are fewer carriers posting their equipment on our load board. That points to typically a tightening of capacity on lower levels of demand. So a similar theme, rates are, the models are in very strong agreement out to the latter part of August. They're looking for about a 5 cent per mile lift over that time frame. At the time of the year when they normally sort of bounce around, but do generally trend downwards. And in flatbed, models are still in agreement for about the 4th week. There's a significant softening in rates underway, much the same as what we observed in 2019. This is pretty much on track with what we see seasonally, although we need a few more weeks of data to see if this downward trend is going to take us below some of the levels we've seen in years like 2018. All right, so Chad, what have you got for us here on your side of the
Yeah, thanks, Dean. So everything Dean has reported prior to this has been from a broker to a carrier perspective, focusing on those spot rates. So what I'll focus on now is the shipper perspective and twist on contract rates. So what we're looking at here is dry van rates. The first metric is our spot premium ratio in yellow. That goes back to 2017. It's a weekly metric. The most recent data point there at negative 5.1% for the week starting 7/7. That means that spot rates were 5.1% below contract rates. This is a great metric to predict the future of contract rates. As we see that metric go above zero, typically a signal that contract rates will be on the rise soon after that as alternatives in the marketplace start to tighten. New rate differential in blue there shows the difference between new rates entering shipper routing guides and the contract rates that they replaced. And so the most recent metric or data point that we have there is negative 1.4%. So this shows that when shippers put new rates into place the week starting 7/7, they did receive a rate decrease of 1.4%. And then the final metric there, the contract rate index, these are long-term contract rates. We did see a tick up there the last couple of weeks. We think this is influenced by some tightening around the holiday. This may start to come down as our data starts to, future data starts to come in. We might see that come down. So let's move on to temp control. Spot premium ratio at negative 0.3%, so very close to zero. This may be a data point that we see normalize as more data comes in, but we're watching that closely. You do see a lot of trend and momentum in that yellow metric, the spot premium ratio over the last couple of months. Again, that is a weekly metric there that we're reporting. The new rate differential still at negative 4.3%, quite low. Shippers getting reefer or temp control rate reductions of 4.3%. And then contract rate index still trending down for temp control. Moving on to flatbed, we see a lot of variability in flatbed. On the whole, flatbed is about 30-35% spot rates, a lot of seasonality in that procurement. So we see our spot premium ratio at negative 8.5%, spot rates quite low compared to contract rates, and the new rate differential at negative 3.2%. And then the contract rate index, pretty flat, bouncing around there, around the 28% area. And then the last metric we'll talk about is intermodal. So we'll show intermodal maybe monthly through our calls here. So in the new rate differential at negative 0.7%, you can see that it had been above 0% for several weeks in a row, but it seems that it's starting to come down, and contract rate index trending down and still quite low. So that's a wrap on the shipper side, Dean.
Interesting reading some of the earnings calls in the last couple of weeks talking about some of the carriers holding firm on their rates, but clearly shippers still have some pricing power there. So Lee, let's talk about the freight market in general. We have a strong sense that we're at the bottom of the freight cycle, but others in the market think the bottom is yet to come. What's your take on where we are in this rather elongated freight cycle?
Yeah, I would agree with you in terms of, I truly believe we're at the bottom. I think we're going to be bouncing along here and slowly moving up in the second half. We do a quarterly survey, and sentiment amongst the participants was pretty poor. And so, I look that as actually a bullish sign, because what they say, it's darkest right before the dawn. And so, when owner operators are coming to us and saying that, they expect rates to continue to go down over the next 3 to 6 months, call it, given how much of the pessimism has increased from quarter to quarter, it just feels to us that we're at the bottom. And then you have a number of demand things going on over the next 6 months. We've been talking about seasonality returning for quite some time. That actually seems to be coming to fruition, which will be a very good thing. We've had a bunch of really weird peak seasons since the pandemic because there really wasn't any easy or normal comparisons. I think the comparisons are beginning to normalize now, and so that should yield growth on both sides. Obviously, it obviously depends on where the economy is going. Recently, the recent Beige Book that came out had some, mixed data. There's also some mixed data on the, the strength of the consumer. The consumer they're buying more stuff online, but they're buying less stuff out in restaurants. But that's a good thing for freight, because obviously the stuff that you buy online is stuff versus things you just consume and works its way through you. More of an experience, if you will. So net, we're relatively optimistic. There's a lot of things that could happen to either increase our optimism and also decrease our optimism, just given the fact that it is an election year and there's a lot of unknowns going forward with how that's going to play out.
Yeah. Yeah, we had, 12 months ago, we were thinking 2024 would be a year when the market would turn. Clearly, as this year has gone on, that's not going to happen. And most of the experts, including yourself, would tend to see 2025 as being a year that may see some sort of economic recovery. What would have to happen for 2025 economic recovery to happen to result in more stuff for us to haul on the back of our trucks?
Well, I mean, the good news is it looks like the Fed is even closer to lowering rates, and that should have, a good impact on a lot of things that we buy,
Right.
whether it makes housing a little more affordable because mortgage rates go down. And, as you know, when people buy houses, they want to fill it up with stuff. So they're buying, whether it's a couch, a pillow, or a washing machine, or maybe even a new vase, that's all stuff. And so that could spur an incremental demand. So, that's one of the reasons why, again, we're probably pretty optimistic that demand growth should continue through here. Expectations are for tepid GDP growth, but we're also seeing a shift back to stuff from services, which is a net good for freight demand.
Lee, on the supply side, as small truckers and large trucking companies think about the cost of the trucks and regulation that's on the horizon, what's on the horizon as far as the EPA goes that could impact the cost of trucks, and could the election going one way or another impact that?
Yeah, so EPA has a new mandate in 2027, pretty much trying to reduce the NOx and SOx of an engine. And while there's not a real definite cost associated with that, we've seen estimates at around an additional $30,000 per tractor. So obviously that is very expensive. We did a recent episode on our podcast talking transports. With the head of the Truck Dealer Association, and she had some pretty interesting points on that. Obviously a Trump administration could maybe push out those mandates further, through executive orders, if the Democrats were to retain the White House, it will probably move closer to that 2027 deadline. Will probably be more of an actual deadline. So it'll be very interesting to see what happens. These new technologies cost a lot of money, and it can be pretty restrictive. If you're a small business owner or an owner operator, and you need to upgrade your tractors, because not only is a new tractor going to be $30,000 more expensive in 2027, you're going to see a huge surge in pre-buys, which will probably increase the price of a tractor, and then also the used market for good equipment is probably going to rise also. So you're definitely probably going to see some more inflationary pressure on the equipment side, which in this current rate environment would yield more losses for maybe the smaller, less sophisticated carriers out there.
Yeah.
Lee, truck orders were down significantly, I think, in June, according to ACT Research. How do you factor that in now when you look at, when you provide research to some of your investors, and how does that play out as a metric that we typically use as a measure of future truckload demand?
So I'm sorry, you said orders are
new truck orders were down significantly in June.
Yeah. Well, I think some of that has to do with that companies right now have a lot of capacity. they don't need new tractors. You know, if you're a large company that has a lot of different businesses, maybe you're moving some of the stuff in your on your one-way business into your dedicated business. So maybe you don't need to buy new tractors. There's a lot of, you know, as you know, whether it's in the spot market, the contractual market, a lot of slack capacity out there, and that's why rates are so depressed. I don't really know if it's telling us much about the future demand for freight, because I think that's going to evolve and that's going to change. And as we get closer to the 2027 mandate that we just talked about, you know, every slot is going to be accounted for, and anyone that cancels an order, there's going to be 4 or 5 people standing behind that person waiting to get that slot. So, you know, that's kind of how we're looking at it right now, at least.
Yeah.
There's another factor at play on the horizon as well with speed limiter regulation. What's the latest on that?
I probably haven't been following that as closely as I should, but obviously that would have a negative impact on a lot of operators out there, and take, you know, capacity out of the market. But, you know, that actually would be a good thing, because if they're, you know, running slower, that means, you know, it's going to soak up some of the excess capacity. You know, as long as trucking companies are getting paid for running slower, I think it could be a good thing for the industry. Some people might be sending me some hate email on that, but, you know, I think it might be a good thing for the industry.
Could be a short-term pain for a long-term gain as the rates correct to adjust for that is kind of the case you're making. Yeah, that makes sense.
Yeah. I'll send you a nice email, I promise.
Thank you. Thank you.
I'm not a fan of speed limiters. It has been pushed back to May 2025. Yeah, so that's been pushed back. This is a controversial topic. It's, as I said on the show last week, it's not speed that's a problem out there. You've only got to go out to the interstates and see that it's got nothing to do with the speed of vehicles. Because most of them are trying to make up for all the excess time they spend on shipper loading docks. So I'll throw that dig in there.
Oh, sorry, Dean. This is something that large carriers have already done? Is that in general true?
Yeah, it's a bit like ELDs, Chad.
Right.
ELDs were the first big fleets were. I was 98 with Werner. Most of the other fleets had electronic logs in by about 2007 when I was working at Qualcomm. So most of them have been speed limited for many years. Some of the big lawsuits that pushed them in that direction, they had to demonstrate they were compliant with, you know, the various speed limits and laws. So not new for the larger fleets, but certainly a big impost on a lot of the fleets that are smaller. So
and you know, it could also net, you know, savings for those that have it, because, you know, if they're running at slower speeds, their insurance rates could be impacted lower from that, because, you know, you're less risk of, if you get into an accident, it might be slightly less severe.
Yeah, it's an interesting discussion, Lee. I'm here in Europe, and the trucks are limited to 90 kilometres an hour. Every single truck is limited to 90 kilometres an hour. The difference is drivers are paid by the hour.
Yes.
Right? So you don't have to rush. You don't have to speed. Like, so it's a whole different mindset. But whenever you're paid by the mile and not paid for a significant chunk of your detention time at a shipper or a receiver, you're going to have pressure for people to do crazy things on the roads. And in the post-ELD era, we've seen some absolute madness emerged, not just with car drivers, but with truck drivers from the start of the pandemic to about where we are now.
Yeah, I was in France a couple of weeks ago, and we were driving the highway, and I thought our driver was being a maniac. But then I realized that because they were zooming past the trucks, and I realized, oh, they must have regulators in their trucks, or they're limited to a different speed limit, which they are. So it's very interesting. And per your conversation, or you're mentioning, you know, getting paid per hour, you know, the way that trucking evolved, you know, I think that would be a great thing for most drivers. I think they would end up, you know, probably making more money and feeling less stressed.
Lee, one of my first customers when I moved here, one of their problems was they were paying their drivers by the load, and we were sent in by the insurance company to do a risk management assessment and turn the business around, because they were uninsurable at that point due to accidents. And one of the first recommendations I had was to change the method of payment from per load to per hour. And that simple change, and we fixed some start times and did some other creative things, but it just took all the pressure away from the drivers having to hurry to try and fit another load in during the day. And their accident risk basically went through the floor. They became a model citizen for managing risk in a 24/7 environment within about one policy renewal. But it will have a profound impact if fleets in the US could move to that model. Lee, what other economic indicators are you watching as you think about the market?
So like I said, we cover a lot of different modes of transportation. When looking at the less than truckload market, we're focused on the ISM. That tends to be a leading indicator. That's been in contraction territory for quite some time. It blipped up positive for just 1 month. I think it was like 3 months ago, but it's been down since October 2022. And so we really need that to see that to go up, to see demand increasing. But as you know, the LTL market pricing is a lot more rational. They're still getting mid-single-digit price increases. It's a much more consolidated market. The top 10 carriers have something like 70% of the market, where the top 10 truckload carriers probably don't even have 10% of the market. So it's a much different market dynamic, much more rational market than the truckload market. So that's something that we're looking at, and really we're just trying to figure out. I'm not an economist and I don't play one on TV, but we listen to our economists, what they're saying here at Bloomberg, trying to get a good sense, and when we think the Fed might be lowering rates, because as we mentioned earlier, that's really going to be a catalyst, or could be a catalyst for freight demand. So the probability of a September cut is increased considerably, but we'll just have to wait and see if that comes to fruition, because there's a lot of uncertainty, especially again, it's an election year, and sometimes the perception is that the Fed might be doing it to help one party versus the other, but the economic data is probably telling them and telling the market that it's time to start easing rates.
Do you have any views on the global oil market, some of the geopolitical risks we might face, our own production levels?
So in addition to covering, North America surface transportation, I cover marine shipping as well. And part of that's the tanker market. The OPEC has been cutting production, but the dislocations created by the crisis in the Red Sea and Russia's war with Ukraine has been good for rates net. And those. The tanker market is a very low order book, as does the dry bulk market. So that's pretty good for rates in general. And what we're seeing is that from the trucking standpoint, is because of all these dislocations around the world from geopolitical forces, is that it seems to be pulling forward peak demand, which we're seeing coming into Southern California. JB Hunt just recently said on their call that they saw double-digit increases of intermodal loads coming out of Southern California.
Mm-hmm. Yeah, on the import side, we've talked a lot about the shift in freight. Do you think some of the increased volume on the West Coast will be sustained, or is that just because you've got fairly low intermodal rates?
Yeah. I mean, I think it's a combination. I think it's hard to measure exactly what's being moved because of fears of a strike in the East Coast and in the Gulf ports. Obviously, as we get closer to September, that probability increases if there's not an agreement. But as you remember, the West Coast lost a lot of business during the pandemic because it became a huge choking point for them. And I think we just might be going back to where we were from a pre-pandemic standpoint, because at the end of the day, the economies of scale that you get from coming into Southern California from Asia is pretty big.
Where do you see intermodal volumes? It's a big competitor of truckload. How are they tracking year over year?
Well, it's interesting. It's really, I guess you would say, regional. Transcon volumes are doing well. In the East, it's doing poorly, and a lot of that has to do with it's a lot more competitive with trucking. People use intermodal for a number of reasons. Some people use it just because it's cheaper. Some people use it because it lowers, their emissions, and they have some ESG targets that they're trying to reach. And some, it's a combination of both. Obviously, in a lower fuel environment, which kind of what fuel's been going down. That has been a a negative for intermodal, because the percentage discount kind of shrinks as the price of fuel goes down.
Right. Anything else, Chad, before we wrap up the show?
No, I think we covered a pretty broad range. Thanks a lot, Lee. I appreciate it.
Yeah.
Oh, my pleasure.
All right. So a couple of shout outs for this week. On our Freightbind podcast, Chris Kaplis is talking to Tim Gates from DP World Americas. I've got Radio Nemoji with Jimmy Mack on Sirius XM on Thursday morning at 8 a.m. Don't forget DATCon, our user conference in Kansas City, October 22. You can use code update100 to register. Next week's show, we've got Scott Cornell from Travelers Insurance talking about physical cargo theft. Before we wrap up, Lee, how can people get in contact with you and listen to your podcast?
Sure. So I'm on X at Logistics Lee. You can find me on LinkedIn. Always happy to connect with people. Love connecting with industry folks. The last name is probably on my screen here, Klaskow. So just search for me on LinkedIn. You can find the podcast Talking Transports, Bloomberg's Talking Transports. You can find it on Bloomberg.com, the Bloomberg Terminal, also on Apple and Spotify, and wherever great podcasts are shown.
Indeed. Thank you. And for those watching, make sure you set up alerts and subscribe to the DAT Freight and Analytics channel so you always get an alert in advance. And with that, episode 301 is in the books. Be safe, be nice to everyone, and we'll see you here again at 10 a.m. Eastern, 7 a.m. Pacific next week.